Many members are telling us that they're thinking more now about employee well-being as well, and so they're bringing in additional measures to ensure that people are properly supported, that they're motivated and developed. Although this is, given the situation and the way that we're working, it's quite an unnatural way of doing things over email, over video calls and so on. So I think this will be a real challenge going forward. And another thing that we're actually hearing is how this disconnected way of working, where we don't have face-to-face contact, might actually be impacting spontaneity, creative ideas and so on. You can't really bounce ideas off each other over email in the same way that you could face-to-face in a meeting room. So I think that could have quite a significant long-term impact. And so another point, I think, what we saw from the results of the COVID risk review really was that people is not only important in terms of a risk, but also as a driver. Most of the top risks that came out in the review were driven in some way by people. So this really does highlight the importance of this aspect in risk management. I think all of the risks that came out in the Horizon report are still relevant. They have just changed criticality, and this really does demonstrate how quickly the situation has evolved and how rapidly things are moving in terms of the coronavirus crisis. Year on year, we have seen some changes in the Horizon results, in the top risks from the Horizon report. But I think this is the most dramatic change that we've seen in quite a long time. This is probably the most fundamental change in operational risk profiles that we've seen probably since the financial crisis. So over the remainder of the year, what ORX is planning to do is to continue to monitor this situation. We're going to run this risk review again at least twice over the remainder of the year, just to monitor how things change over the year. The biggest concern that we're hearing from members is the potential for an increase in conduct risk. And I think there's a number of factors that are really driving this. So firstly, because we have these government-backed products that were very quickly set up, and especially in the current environment where we've got fewer supervisory controls and maybe controls that were really designed to operate in an office environment rather than remote working, there's more opportunity for things to go unnoticed, opening up to a few more exposures, I think. And where we combine this with an economic downturn, I think we're going to potentially see people more motivated to sell and therefore mis-sell. Another thing which I think might develop further, although it's been somewhat addressed initially, is third-party risk. I think as we develop into the economic downturns, there's more chance that third parties aren't going to be able to maintain liquidity. So many third parties aren't really as prepared in the same way as our financial firms, which have large reserves, they have extensive business continuity plans. Smaller third-party companies don't always have those same resources. So I think members are telling us now that they're starting to really focus on maintaining the financial resilience, not only of themselves, but also of their third parties, just to make sure that things can operate and continue to operate during the economic downturn.